Our topic today is everything you need to know about trust accounts. And with that, I will turn it over to Susan Humiston, Krista Berry, and Annette Winrick from the Office of Lawyers' Professional Responsibility.
Good afternoon, everyone. My name is Krista from the Minnesota Office of Lawyers' Professional Responsibility. Thank you for joining us today. We'd like to start with the basics of trust accounts. And starting with the absolute basic is, what is a trust account? A trust account is an interest-bearing bank account that contains funds entrusted to a lawyer's care. We would refer you to Rule 115.0, which defines the different types of accounts that can be used as a trust account. And the purpose of a trust account, there are two. One is to safeguard funds, client funds, and third-party funds that a lawyer receives in connection with representation that are in a lawyer's possession. And the second is to keep those funds separate from the lawyer's own funds. And Rule 1.15 governs a lawyer's obligations for maintaining, accounting for, and distributing client or third-party funds that are in the lawyer's possession. Appendix 1 interprets Rule 1.15 and goes through all of the lawyer's record-keeping obligations and bookkeeping obligations for trust accounts. Most lawyers in private practice will require a trust account. Commonly, lawyers need trust accounts, but they're paid a retainer or a flat fee for work to be done in the future, or if they receive settlement funds before they are dispersed. Any funds in either of those categories must be deposited into a trust account and must be removed only as they are earned. Therefore, only in-house counsel, government lawyers, and other lawyers who never hold funds on behalf of a client or a third party are really the only attorneys who likely will need a trust account. I also wanted to highlight for you the certification requirement that is present on the annual lawyer registration. For your annual registration, you do have to certify that you are keeping your trust account and you're keeping the records required under Rule 1.15 in Appendix 1. And that is a statement that you're attesting to every year. And that is something that we do as an office look at when there problems do arise or issues arise with trust accounts. We look to see if attorneys have certified every year that they either have a trust account or don't, and that they are compliant. So next I wanted to talk to you about an IOLTA account. IOLTA accounts are pooled accounts. And it stands for an interest on lawyers trust account, but we commonly refer to them as IOLTA accounts. And it's a pooled interest-bearing insured account for client funds or third-party funds received in connection with representation of a client. They are used when a lawyer is holding funds on behalf of multiple clients or third people, but they hold them in just the one account. And any cumulative interest is calculated on the pooled balance, not on an individual. Not on an individual basis. We frequently get questions on our advisory opinion service dealing with IOLTA accounts and how to set them up. And one of the things that we are commonly asked is if you need special trust documentation in order to open an IOLTA account. And the answer is you don't, although sometimes banks may think that you do, but one is trust documents are not needed to open an IOLTA account. The funds that go into an IOLTA account, because they're pooled, and this refers to Rule 1.15e, when the funds will generate a nominal amount of interest or they're held for a short period of time, they should go into this pooled account. An interest that is generated on the IOLTA account does not belong to the lawyer. It is generally it is a nominal amount, and it is paid into the IOLTA program, and that is used for nonprofit legal service programs. That interest that is calculated. A lawyer can set up individual accounts for specific clients. It is a lot of work, and it is frequently not done, but it is permitted. So in an alternative to a pooled account, a lawyer could open an IOLTA account sorry, not an IOLTA account, a trust account for an individual client, then all the same records that are required for the IOLTA account and bookkeeping, as laid out in 1.15 and the appendix, would have to be done for that specific client, and that interest that is earned on that individual amount would then go to that client. IOLTA bank accounts need to be opened with a bank that has, or a financial institution that has been approved by the OLPR and has an agreement with our office. A list of those banks are provided on our website and also refers back to Rule 1.15J. And that is because banks that operate IOLTA accounts agree to calculate and award a certain amount of interest on their interest rate on that account. And they also agree to notify the OLPR when those banks are overdrawn. And so that is why it has to be at a certain financial institution. IOLTA accounts should be prominently designated as a trust account or an IOLTA trust account. It's important that be done so that any creditors or anyone looking at that account know that it is a fiduciary account, that those funds are held in trust for someone else. That should also be done to give notice to creditors that that is a fiduciary account and not an account belonging to the lawyer. Your business account, in contrast, should also be designated prominently as a business account or an operating account to differentiate it from the fiduciary account. A practice tip would be using different colored checks to highlight that difference for yourself so that it's easier to maintain that distinction. And a question that we also commonly get is, can a lawyer have more than one trust account? And yes, there is no limit under the rules to the number of trust accounts that a lawyer can have. However, it is a lot of work to maintain more than one trust account, as you would have the same reporting, record keeping, and bookkeeping obligations for each account that is operated. And Rule 1.15G lays out considerations for lawyers to think about if they are deciding between whether or not to have a pooled IOLTA account or individual trust accounts for a particular client. Basically, it comes down to, will the funds accrue a substantial interest during the time you're holding the funds, or will the interest accrued remain nominal? And the guiding principle here is that if the interest is going to be more than the cost to maintain the separate account, then an individual account should be set up. This is an unusual circumstance, though. The most typical example would be if you are representing a party in a dissolution proceeding, and if you are holding proceeds from the sale of a homestead, for example, for a substantial period of time while you're awaiting a final decree, that would be the kind of situation where the interest that accrued may be more than nominal. But if it is a nominal amount, it can be maintained in your pooled IOLTA account. Next, we're going to turn to the record keeping obligations for trust accounts. And like I've referred to several times, any and all trust account that you have are subject to the same record keeping requirements as laid out in Rule 1.15 and interpreted by Appendix 1. And that applies to each and every trust account. And that is also the same whether or not it is a pooled IOLTA account or an individual trust account. And you must maintain those records for 6 years. When you are closing, or if you are moving a trust account from one financial institution to another, you would want to complete the same steps, which is notify your bank that you are closing the account. And then you also need to submit notification to us, and that form can be found on the following website here. It's minnesotacourts.com .gov, sorry, form, and you can submit it electronically, and you must provide notification that you have closed that trust account. And then we would also just remind you to be sure to account for any accrued interest for the period that's happened that hasn't been paid out, but has accrued before the closure date when you're doing your final calculations for closing that account. And next, we're going to turn to the books and record keeping obligations for trust accounts. And this I would highly recommend looking at Rule 1.15 and also Appendix 1, which lists out all of the requirements for books and records for trust accounts. Appendix 1 is really going to be your best friend when you're thinking about your trust account obligations. And really the theme throughout is just documentation. Keep records, keep everything. And really make sure that you're keeping everything and not just 9 of the 10. You have to keep every kind of record that is required, not most of them, in order to be compliant. Records can be kept electronically, but again, we would really encourage you to back them up daily if you have a lot of activity on the account, maybe less frequently if you don't have that much activity. But it's very, very important if you're going to keep your records electronically that you are backing them up. Because that would not be a defense to having them if a system crashes or something happens. So please back up your records electronically. To start with, what are the records that are required? That again is Appendix 1, but it's subsection I-6. It comes after the description of the required books. And records generally refer to those documents that you get from your bank. They're ordinarily maintained by the bank. So your bank statements, your canceled checks, your deposit slips, confirmations of transfers, interest reports that you receive from the bank, those kinds of records. Banks routinely provide them to you, and those kept records again must be kept for 6 years. Regarding specifically canceled checks, it's a little different than the rest of the records. If your bank does not return canceled checks with your bank statements, some banks do and some banks don't. And if your bank does not, then you are not obligated to maintain copies of those. However, for deposit slips, if your bank does not return them, you still must document them. And how you would do that is the lawyer would create and keep duplicate deposit slips, sometimes with that old school book with the carbon behind it, or another way that a lawyer follows to just maintain kind of that copy. So canceled checks and deposit slips are treated differently under the appendix. And then to go through what documentation you need to maintain when you open a trust account. You need to maintain records that show basically the general information for opening the account, the name of the financial institution, the account number, the name on the account, the date you opened it, and a copy of the application that you fill out at the bank when you open it. This should be maintained to show all of the information for each trust account that you have, and any pooled account. You should also keep a record showing participation in the IOLTA program and the clients that are covered by that account. Then we turn to deposit slips and withdrawal records. Each deposit slip that you have must be annotated if it's not done already by the lawyer once they get it. And so you must include the name of the client and the amount. This is particularly important if you have a deposit slip that covers more than one client. If you make a deposit that affects multiple clients, please be sure to have the full name of every client, not just, for example, Anderson, because looking back several years later, you might have more than one client by the name of Anderson. So use full names and the amount per client, and that just is of particular importance if you have a deposit slip that covers more than one client. Mobile deposits are a question that comes up frequently these days, especially with how we bank is changing. Mobile deposits, and that would be on an app on your phone, those are permitted. However, the lawyer must request and retain either an image statement from the bank that includes the words official copy or something from the bank to indicate that it is being used as a substitute check deposit. So in other words, you want something more than just a camera shot on your phone, but you can deposit over a phone app. You can also deposit through the ATM. That's another way that it's banking is evolving. We're no longer doing all of our banking in person at the counter. And ATM deposits into your trust account may be made, but you must also retain the deposit receipt and clearly annotate it the way we talked about before with the client, full name of the client and the funds that were deposited on that client's behalf. Cash payments, I wanted to highlight for you because they are a little different. You can take cash payments and you can make cash deposits into your trust account. However, one of the things we see that's a little different for cash as opposed to other forms of payment is that the receipt must be countersigned by the person who made the payment. Not just the lawyer receiving it and not just giving that person a receipt. The person paying in cash must also sign it. That means that some of the more typical things like a text message acknowledging receipt of money would not be okay if it was cash, or any receipt that is not countersigned would not be okay if the payment was made in cash. Any withdrawals from a trust account can be made by check as long as they are annotated with the client's name. Electronic, telephone, or wire transfer withdrawals are also okay from a trust account. However, lawyers are required to create their own memo authorizing the transaction and also sign it. That memo must identify the client, the amount of the transfer, and the date of the transfer. That memo is created by the lawyer and maintained by the lawyer for withdrawals that are done through those transfer methods.
Hi, this is Annette Winrick. I'm going to take over for Krista for a little while. I'm the auditor here at the OLPR, and I work with the overdraft program, and I also just help with trust account books and records for any of the issues we come across. So I'm going to talk to you about what are books. Books are the materials that a lawyer tracks to find their trust account activity, whereas records are provided to you by the bank. The required trust account books include check register, client subsidiary ledger, monthly trial balances and reconciliations, receipts and disbursement. Journals are optional, you don't have to do that, but we also require you to prepare and sign a memorandum authorizing any electronic and electronic disbursements from the trust account. On the screen, you can see an example of a trust account register that shows in chronological order, all of the deposits made into a trust account and all the disbursements from the trust account. It's required that the check register show a running daily balance of the funds in the trust account. In addition to the check register, the check register must show the date of the deposit, the amount of the deposit, some type of identifier for the client and on whose behalf the funds were deposited. So the client's name, a client number, whatever you're going to use to keep the record, and a brief description of the purpose of the deposit. For example, is it a filing fee advance? Is it settlement proceeds or something else? Then in respect to each disbursement entry, it must show the date of the disbursement, the check number, if there is a check number, the payee or the recipient of the disbursement, the amount of the disbursement, and then a client identifier. Again, it could be a name, it could be a file number, whatever method you choose to use, but we need to be able to tie it to a client. And a brief description of the purpose of the disbursement. For example, filing fee, settlement proceeds, and anything like that. You can find these requirements in Appendix 1 of the MRPC. In addition, a lawyer is required to maintain a separate subsidiary ledger for each client with a balance or activity in the trust account. The subsidiary ledger should have all the trust deposits, disbursements for each individual client. Any nominal firm fees held in the trust they also require a subsidiary ledger. This is one of the areas that we tend to see fall to the wayside, but I want to remind you that it is a required books and record. Each client should have a subsidiary ledger. So when you're keeping track of this, each deposit should appear on the subsidiary ledger and include the same information as required in the check register. Again, that's the date of the deposit, the amount of the deposit, a description of the purpose, and each disbursement likewise has to have that information, the same as the check register. You're going to have the date, the check number, the payee, the amount of the disbursement, and a brief description of the purpose. Like the check register, each subsidiary ledger has to show a daily running balance. The importance of the daily running balance is twofold. One, it allows you to immediately detect if there's a negative balance in the subsidiary ledger, which is an indication of a problem. And two, it facilitates in the month-end trial balance process. And we'd like to point out that failing to keep subsidiary ledgers is one of the most common deficiencies. And if you're, and it makes it that likely that you're unable to reconcile your trust account. You need all of this information or you're not going to be able to balance at the end of the month. So no client subsidiary ledger should ever reflect a negative balance. If you have a negative balance, that indicates that you've dispersed funds on behalf of a client that exceeded the amount that you had on fund for that client. If that happens, what you're doing basically is using another client's funds to fund that disbursement. And when you do that, that constitutes misappropriation, which is a big deal. So when a client's representation is concluded, you should have a zero balance. You shouldn't have any negative and you shouldn't have any funds remaining when you discharged your work with that client. We can like to point out that you can maintain a small amount up to $200 of your own funds in your IOLTA trust account. However, you do need to keep a separate subsidiary ledger for those funds and track everything going in and out. You are not really allowed to keep anything more than that because you don't want to commingle your funds in the trust account like Krista talked about earlier. Each trust account, whether it's a pooled account or an individual client trust, is required to be interest bearing. If the then you have to remit that interest to the IOLTA program. So if you need, like Krista talked about a little bit earlier, you have to be really careful about when they're giving you the interest and when they're sending it to the IOLTA program. There are some banks, a lot of banks, that will do it almost simultaneously on the same day or at least in the same month. And that makes it easier to keep your records. But if the bank that you choose does not submit on a monthly basis or even in the same month, that's accrued, just keep in mind that you have to account for that interest. You can find all of this in appendix to the MRPC. This is a sample of what a subsidiary ledger would look like. You can see the dates where the interest was credited and remitted, a description of the transaction, the amounts of the interest credited, and the running interest balance. You could have the same type of ledger for your firm funds and you just label it differently. So a monthly trial balance report is a listing and a totaling of the balances reflected by the client subsidiary ledgers, including the firm funds and the interest ledgers, if any, as of the date of the bank statement. The monthly trust account reconciliation requires comparison of this trial balance total to the check register and the bank statement once you've adjusted it for uncleared activity. So if your bank statement doesn't reflect a deposit or checks that are outstanding, you're going to want to adjust for that. The purpose of this reconciliation is to catch mistakes, and that could lead to shortages or commingling. But we'll walk you through the steps of computing a monthly trial balance and reconciling it with the checkbook register. First, the checkbook register can be found last. Excuse me. A trial balance Report lists and totals the balances reflected by the lawyer's subsidiary ledgers, including any maintained for interest in the lawyer's own fund in the trust account as of the date of the monthly statement. So the lawyer's records show every subsidiary ledger with a balance as of the bank statement date on the trial balance report and calculates the total of those balances. As shown in this example, the client Bates has a zero balance, and client CC has 2,393. And then Davis has 578, firm funds of 100, and there's interest sitting in that account of $19.19. So your trial balance would be $3,490.19. The trial balance total must be compared to the check register and the bank statement adjusted for your uncleared activity. In this example, the balance was $3,490.19. We're going to assume that the check register balance was also $3,490.19. The actual bank statement balance on January 31st was $5,905.19. When the balance is adjusted for checks that were issued and posted to the check register and the ledger in January, but they hadn't cleared the account, the adjusted bank balance is also $3,490.19. These adjustments consisted of uncleared checks in the amount of $340 and $2,075. So all three of the balances, your check register, your trial, and adjusted bank statement should be the same. If they're not, that means you made a mistake and you need to go back and fix it. For example, if you failed to record a particular check in the check register or recorded it in the client subsidiary ledger, or you overlooked an uncleared check as part of the bank statement adjustment process. Whatever the problem is, that's when you need to correct it, is right now, get your books in balance. So now it's time to reconcile. The check register and trial balance may not match the bank statement because there are uncleared checks and the deposits that haven't posted. So after adjusting the bank statement, all three balances, the check register, the trial reconciliation, and the bank statement should be the same. If they're not, you need to go back and discover and correct any errors causing the imbalance. So when it comes time to deposit funds into a trust account, we'd like to make sure that you understand a few things. Any checks that are coming out of the account have to be signed by a lawyer. If your firm requires two signatures, at least one of them must be a lawyer. If you have any disbursements through wire or electronic, you need to accompany that with a written memorandum and have that signed by a lawyer. You can deposit money into a trust account via deposit, ATM deposit, or wire. Do you have anything else to add, Krista? Did you want to talk to them about how to handle credit cards, Krista?
Yes, thank you. Something that often comes up is, are you allowed to accept payment by credit card, as that is a common way that people and third parties and clients transact and pay people these days. And yes, you are able to accept payments by credit card. This is authorized under Appendix 1, Part 1, Paragraph 10. However, we would highlight for you that you should use caution in accepting payments by credit card because a third party, which credit card companies often require, cannot have access to your trust account. And that typically with credit cards happens if they want to require that they can do reversals or recoup fees or take other costs associated with processing a transaction out of your trust account. And so there are ways to handle that. If you can set it up with the credit card company that they will deposit into the trust account, but will take fees and reversals and anything of that nature from your operating account, then that's okay. You can also consider using a third-party processor such as LawPay that can take care of handling that. But the important thing to remember is that the credit card company or any third party at all cannot ever have access to your trust account itself. That would jeopardize the fiduciary nature of the trust account. The type of credit card fees that would be assessed will depend on the payment itself that is being made, what it is for. So that will determine how a lawyer should process the credit card transaction. The first type would be earned fees. So if you have already earned the fee, you've already performed the work, and you are simply collecting payment for that fee, you can do so by credit card, and that credit card transaction should go directly into the business account or the operating account because it is earned. You do not want to commingle your earned fee, which is the lawyer's fee, with third-party fees that are in the trust account. So if it is for work that has already been performed and the fee has already been earned, that credit card transaction should go through your operating account. If it is an advance fee or a flat fee by credit card that is not, and the flat fee is not being done pursuant to a written fee agreement under Rule 1.5B1, then you would handle it differently. And just a side note on flat fees, because that would be a whole CLE in and of itself, all about different fee agreements and particularly flat fee agreements. That is beyond the scope of today's presentation. But for now, I would just refer you to Rule 1.5B1 for the requirements for a flat fee agreement, as those are relatively common agreements, particularly in the criminal sphere, that have requirements for when you can do a flat fee. And if you meet those requirements, you can then do you can handle the flat fee differently. But for purposes of this discussion, we're going to assume that it is an advance fee or a flat fee not pursuant to the requirements of Rule 1.5B1. If that is the case, then you're basically receiving a fee for services that have not been performed yet. You're going to be performing them in the future, therefore they have not been earned yet. And that's either typically a retainer or a flat fee not according to these requirements. And then you'll be invoicing either on an hourly rate or some other calculation for future work. So until you've earned it, it is unearned and must go through your trust account. And then the question is how to do that with a credit card with the caution that I spoke about previously, with not allowing a third party to have access to the trust account. So if you do have a way to work with the credit card company that they can credit funds to the trust account while agreeing to do any debiting exclusively from your operating account, then you can run the transaction through your trust account. If, however, the credit card company cannot do that, or that's not an agreement that you can enter into, and you aren't using a third-party processing company like LawPay, which we would recommend, then what you should do is run the credit card transaction through your operating account, and then immediately being the key word, transfer those funds to your trust account. That way, the funds are being properly put in your trust account because you have not earned them yet, and you are avoiding any problems with giving a third party access to your trust account. And one final one thing to note about credit cards, as I'm sure you're all aware, just in your own lives, often there is a fee associated with credit cards. And so some businesses maintain a minimum that they will do or try to pass on that cost to the consumer as an add-on fee if you pay by credit card. And we strongly encourage you to just consider this an overhead fee and not try to recoup it from your clients. If you want to attempt to do that, we would suggest that you review the Minnesota Consumer Protection Act, because that would apply to any such transaction of assessing that fee to the client. And that's statute 325G.051. It has various requirements ranging from having notice displayed in your office and also puts limitations on the amount that you can recoup. For example, it can never exceed 5% of the underlying transaction. And so those fees, we just strongly recommend that you consider that overhead. But if you are going to pass it on to your client, please review the Minnesota Consumer Protection Act before doing so. Now we're going to move on to disbursements from the trust account. And that is covered Appendix 1, subsection I, subsection 11. And the important thing to keep in mind when you're dispersing funds from your trust account is to make sure that they have cleared the bank from which they're being drawn. In other words, you can't disperse a settlement check usually the same day that you deposit it, because it takes time for it to clear from the originating bank. Exceptions to that would be for cash. So if you're depositing cash into your trust account, those funds are typically available the same day. And that's also the case for wire transfers or certified checks that are more common in real estate transactions. Those are typically available the same day. So this brings us to the question, though, of what does it mean for a check to clear? Because there aren't hard and fast rules, they're just general guidelines, and they can vary based on the banks that are involved and their location. So example would be a local check being to Minnesota banks usually clears in 3 business days, but out of town checks, particularly foreign checks, can take 10 days or even longer. And so it's important to familiarize yourself with the terminology that your particular bank uses and to understand the distinction between funds being available, as your bank may indicate, and when the check has actually cleared. Some banks will mark funds as being available upon you depositing, but that does not actually mean that the check has cleared. And you want to be really careful that you don't disperse any funds until they are actually, the whole banking process has concluded and the funds are actually in the account. Another thing that comes up with dispersals from trust account is the common question of, can you post-date a check? The answer is an emphatic no. Please, please, please do not post-date checks. Sometimes banks will cash them without looking at the date, but please do not do this. And it's part of your responsibilities as a lawyer to explain to clients who are understandably pretty antsy to get settlement funds that they are not available until the entire transaction has cleared the system, and that can take time, sometimes several days, and that the funds just cannot be dispersed until that happens. Another common area of dispersals from trust accounts are flat fees and advanced fees. And as we talked about previously, that is when a fee is agreed to, but it's for work that has not yet been performed. So you are receiving part of your fee, but the work has not yet been done, and therefore the fee has not yet been earned. It has to be deposited into your trust account until it is earned. And that's, I would refer you to Rule 1.15, subsection B. And that means that it has to go into the trust account until that time. And so you cannot remove those fees from the trust account until you have earned those specific fees and documented how, what percent you've earned or what amount you've earned. Some lawyers use hourly basis, task basis, event basis, whatever process you set up. The important thing to remember is that you cannot remove those fees from the trust account until they have been earned. Another common way that lawyers make disbursements from their trust accounts are regarding costs, either when a client advance costs to you as the lawyer, and then you disperse them as you incur those costs, such as filing fees or expert witness fees or similar costs like that. Another way that this can come up is if the lawyer pays the costs themselves and then the client reimburses them for those costs. So under the first scenario, when the client has advanced payment of costs to you, you deposit those advances just like you would deposit an advanced fee because they have not been spent yet into trust, and they can't be removed from the trust account until those costs come up and are paid. So you could write a check from your trust account for those costs, and it would come out of the portion paid in advance by the client. And just be important to document on the check and in your records the specific cost that's being paid for, the person who's being paid, the client that it is in benefit of, and the date, but really identify what the cost is. Is it a filing fee? Is it an expert witness, etc. It's slightly different when the lawyer is paying the cost and then is being reimbursed by the client. If that's the case, then the deposit for those costs need to go into your operating account and not the trust account, because it's a reimbursement and you don't want to, again, commingle your funds. You don't ever want to mix your earned property, your funds, with the funds that you are holding in trust. And turning now to the common ways that you can take your fees once they have been earned out of an amount that's in trust. And it's important that you do that promptly, again, because you don't want to commingle. So you want to promptly remove fees that you have earned from the trust account. And you can do that in several ways. The most common would be through a check. And so when you have earned the fees, you would simply write a check from the trust account either to yourself or the law firm or your operating account, taking care to annotate it, as we've previously discussed with the full client name, the amount, and other information to indicate that it is for earned fees. You can also do this through an electronic or telephone transfer. Bank wire, electronic telephone transfers are a way to get earned fees from your trust account into another account, and usually are done to the operating account or other non-trust accounts of the law firms. And the name, it's basically the same transaction, but it's a little different depending on the identity of the bank. So an electronic transfer can be done if the two accounts exist at the same bank. Other transfers would be done not electronically, like by wire, if the banks were two different institutions. But again, just to remind you about if you're transferring earned fees by any of these transfers, electronic, telephone, or wire, that you would also be responsible for maintaining that memorandum that we discussed earlier, that the lawyer creates, that authorizes the transaction and is signed by the attorney and gives basic information about the transaction. Another question that comes up is, can you take cash withdrawals or debit card withdrawals from a trust account? Again, an emphatic no. No, you cannot do that. I'd refer you to Appendix 1, subsection 12B. You cannot make cash withdrawals from a trust account, either in the form of using a debit card at the ATM, which you're not allowed to have a debit card linked to your trust account, or by writing a check out to cash would be another example, or trying to do a cash withdrawal at the counter. You cannot do any of those things. No cash withdrawals from your trust account. Next, I want to just go through some common questions we get, frequently asked questions, if you will, either in the advisory line or just in speaking to lawyers. Uncashed checks seems to come up a lot, and there are many reasons why someone might not cash a check. Either they've misplaced it, they forget about it, for whatever reason, the check is written, it's issued, it's received by the party, but they just don't ever cash it. And what do you do with uncashed checks? And hypothetical here is, lawyer wrote a check for $350 to the client's doctor a year ago, but it has never cleared the bank. The lawyer is tracking it as required in their check ledger and trial balances each month, but they're wondering how long they have to keep doing that, especially when you consider that after 90 days, most banks will consider the check stale and may or may not cash it if it is presented. And this raises several issues because of that issue of whether or not a bank would cash it. So you don't want to simply issue a new check, because what happens to the previous check? What happens if the person tries to cash both or one or the other? So really the only guaranteed way to handle this would be to have your bank put a stop payment on the first check, and then reach out to the person to figure out if they need a new check or how to best pay them. But you definitely need to use reasonable and best efforts to make contact with that person to determine why they haven't cashed the check and how to get them those funds. But you don't want to create an issue where there are two checks out there. So if you are going to issue a new check, just make sure that you have stopped payment on the first check. A second issue that we get, that we hear a lot about on the advisory opinion side of things, is when client property, client funds in this case, has been abandoned. If you're holding on to client funds for several years, what's the procedure for that? And the hypothetical here is, a settlement check. You have it, it's been 4 years, you can no longer locate the client. You've exhausted all reasonable means to find them. What do you do with this money? Are you obligated to hold it indefinitely, or what is the procedure for that? And the starting point here is that we would definitely emphasize that you do need to use reasonable efforts and good faith to find the client first and foremost. And that could be, using Google, checking the post office. You basically just want to be able to document that you have used good faith and reasonable efforts to find the client. And you need to be able to document that if you're going to take advantage of the abandoned property statute and do anything with the property that way. So if you have access to Clear, or you can run a people search in Westlaw, you should do that, because your first step is going to be obviously to try to find the person. If you have exhausted reasonable efforts and you cannot find them, you can take advantage of the abandoned property statute, which is Minnesota Statute 345.32, and that entails transferring the abandoned funds to the Commissioner of Commerce if it has been at least 3 years. It should be transferred in the form of a check written from the trust account, and it be sent with information that details the efforts to find the client's name, the last known address. You should also, just for your own record keeping, keep a copy of that report if you go that route. But again, just to emphasize, the high points is it has to be at least 3 years, and you do have to have exhausted good faith efforts to locate the client before you take advantage of the abandoned property statute. With that, I'm turning it back to Annette.
I'm going to talk to you a little bit about the overdraft on trust accounts. Hopefully none of you have experienced this, but we'd like to explain to you that under Rule 1.15K MRPC, banks report overdrafts on the lawyer's trust accounts to the director's office. Those reports are made to the director's office at the same time the lawyer is notified. So upon receipt of an overdraft notice, the director will notify the lawyer or the law firm of the overdraft and will request the following things. 1, a written explanation for the overdraft. 2, a copy of the instrument that caused or contributed to the overdraft. And 3 months of your complete trust account books and records. We request these books and records both to confirm your explanation of the overdraft and to ensure that you're maintaining proper trust account books and records. So the letter notifying the lawyer of the overdraft states that you need not provide any of the accounting if it is caused solely by bank error. But we're very specific about what truly constitutes a bank error. So, for example, if you're unfamiliar with the bank deposit hold policy, that is not a bank error. If you mistakenly use a deposit slip from your business account rather than the trust account, again, that is not a bank error. Bank error would actually be an error made on the part of the bank employee. For example, if they posted a check that was supposed to be going into your trust account into an unrelated person's account without any control of you, that would be a bank error, and they would report that straight to us, and we would pretty much be finished with that case. What we do, though, when that isn't the case, is we review the explanation and look at the books and records that were provided to confirm the cause of the overdraft and ensure that the books and records are being maintained. If the explanation appears adequate and overdraft and the overdraft has been fixed, it can quickly be terminated if we really don't feel like there's anything else going on. If a minor problem exists, we can talk to the attorney and inform them of the problems and require them to submit corrected books and records. So give you a chance to get it all straightened out. And if we're assured that the problems are resolved, sometimes that can be terminated without disciplinary consequences. But if the books and records show that there's a chronic or serious problem, such as shortages or commingling, we're going to open a formal disciplinary investigation and have a full-blown audit. So these are just some statistics on the overdrafts. Recently, the director's office has had 40 overdrafts. I think that was from last year. Prior to that, it was more in the 60 to 70 case range. So that's good news that we're getting less overdrafts. The majority of them that we receive are closed without a disciplinary file. And the top causes for overdrafts, as you can see over here, are checks written error on a trust account. Again, like Krista said earlier, if you get different colored checks for your business account and your trust account, that could help there. Bank error, that does happen. Charges from the bank, late deposit, always make your deposit first, give it a few days, and then pay your bills. But that's a big deal that the deposits are late, or mathematical or clerical error. Or again, if you deposit into the wrong account, you put it into your business account, you think you put it into your trust account, and the funds just aren't there. So on the slide, you can see the top bookkeeping errors. And the first one is no client subsidiary ledgers and or monthly trial balances and reconciliations. We see that a lot, and it's really hard to keep track of what you've got going on with your business and your bank account if you're not keeping all of the required books. Another problem is if you don't detail your deposits, you don't keep track of who that money belongs to and what the money is to be used for, whether it's fees or costs. That is an important component to keep your books and records clear. Another one, like Krista talked about earlier, is if you're not backing up your system. And again, like she said, if you use your trust account a lot, just back it up every day. It's a pretty simple thing to do, and it'll save you a lot of headaches. The other thing that if you're not keeping good records on your uncleared checks and deposits, you're not accounting for them in all of those places that you should be. If you are not paying attention to your interest, again, there's a lot of banks out there that will give you the interest and then take it and send it to the IOLTA program seamlessly within days. And that makes it easier. But if you aren't banking with someone like that, you just need to make sure that you're always accounting for those the accrued interest, because even if that you just overdraw by a few cents because of the interest, you're going to get a letter from the director's office. Make sure that you always have a lawyer sign everything, track and cover your check printing. So that's what your $200 firm fees can cover, is anything that's just a business expense. But make sure you're paying attention to that. And then you can always use software such as QuickBooks or Quicken. That makes keeping your books and records so much easier.
And now we're going to go into basically how to avoid discipline by talking about the common record keeping errors and misuse of trust accounts that we see. Before we get started on that, though, I do just want to let you know that this is not supposed to be scary. This is more telling you about the things we see most commonly in an effort to teach you not to do them, so that you don't make these mistakes, learn from the group, if you will, and not make the common mistakes that we see. This is definitely not meant to be scary, hopefully just to show you kind of how not to do it and how to do it the way that you're required to, so that we never see you. And really the most common thing we see is just simply not keeping the required books and records, or keeping, and by that we mean, there are a lot of them laid out in the appendix 1, and you might keep most of them. But so really the most common issue is just not keeping all of them. And that can lead to other problems, and it can also lead to not catching other problems because you don't keep the required books and records. So that would be really the most common. So if you can just make an effort to really understand the required books and records, and particularly the monthly reconciliations that Annette was talking about, that will not only keep you from committing the most common misstep, but will also allow you to catch other things that might be happening. Just like in your own record keeping and financial life, your personal life, if you don't keep a record of your checks, how do you know what's going on in your checking account? You know, you can't possibly remember checks without keeping those kinds of records. And just to highlight that, you know, not knowing that you're supposed to keep certain records is not a defense. It's also you can't just delegate the responsibility to someone else and leave it at that. If you are going to delegate responsibility for maintaining your books and records to either another lawyer in the firm or a non-lawyer employee of the firm, you have to supervise and ensure and explain that it's being done properly. You can't just delegate it and kind of wash your hands of it at that point. You have to be involved to the extent that you necessary in order to supervise it, know that it's being done properly. The most common books and records that aren't maintained, as Annette also discussed, is that client subsidiary ledger and the trial balance report. They're the ones that even when people are keeping other books and records, those will be the things that are most often missing. And those are really important, mostly for their value in being able to detect other things that are going on. If you keep those ledgers and you do those balance reports every month, that's when you're going to catch if a check gets deposited in the wrong account, and you'll catch it before it gets bigger and before it actually harms anybody. You'll catch it right away. And so these are just really important books and records to keep for that reason, in addition to the fact that they are required. But you want to be able to make sure that you're catching things when you're still able to fix it in a timely manner.
And also, Krista, this is Susan. I just wanted to jump in here and reiterate the point that you're making when you talked about when people delegate their responsibilities to non-lawyer assistants, which is absolutely something that you can do. But I really think that not only do you have an individual responsibility because it's your trust account, you're the fiduciary holder, but also because you have a supervisory ethical responsibility under the Rule 5.1 and 5.3, depending on who you're supervising. You need to be looking on a monthly basis that the reconciliation has occurred and that everything tied out. And I think it's very hard for any lawyer to explain to us when issues come up that they delegated things, they assumed everything was going fine and they hadn't heard any problems. All can be fine and true, but if you are not looking on a monthly basis to ensure that that three-way reconciliation is happening and you know that things are tying out, how can you say you are in fact maintaining the required books and records and discharging your ethical duty to supervise the people who are doing that work? And I cannot emphasize enough to people on this call that I know this is boring and a lot of things that nobody wants to do because we didn't go to law school to be an accountant or a bookkeeper, but this is a fundamental aspect of your legal responsibility. And so just don't put off until, a time that won't come to do this on a monthly basis or think, oh, I was on top of things and then I got super busy and everything's going on. I need to get back to that, but time passes on you. Just do not let that happen. This is a monthly obligation that should be taken place. And that is where we see, we'll talk more about where it goes from there. But keeping those two things in mind, supervise and look at it and be doing it on a monthly basis in every instance is really, I can't emphasize that enough. So I just wanted to pop in and say that, Krista.
No, thank you, Susan. And actually that has been ruled on by the Supreme Court in La Chapelle, which is that the case on the second point there with non-lawyer assistance, the Supreme Court said that at a minimum, a lawyer should review those monthly trust account trial balances and reconciliation. So at a minimum, according to the Supreme Court, it should be done monthly, even if you've delegated it. And thank you, Susan, for that reminder, because that is a very important point and something that in practice, probably a lot of you will end up, if not delegating, having help from both other lawyers in your firm or non-lawyers in your firm. And so it's a real life thing that's probably going to come up for a lot of you. And it's important to keep in mind that we do know that at a minimum monthly, you should be reviewing those things yourself. Which brings us to another point along those same lines, which is basically shared responsibility, shared discipline. And so another reason why it's important that you do at a minimum those monthly checks yourself is because if you share the responsibility or delegate the responsibility of your books and records to someone else, another lawyer, you will both share the discipline because you're sharing that responsibility. And would highlight that that's true if you're law partners, if you're another lawyer in the firm, and it's also if you're have non-lawyer staff. And then of course, as Susan spoke about too, you have rule 5.1 and 5.3, the implications for other rules as well, in addition to books and records, because of that supervision aspect, depending on who you are supervising. But that's another reason why it's important to definitely be involved still in the process, even if you have delegated to someone else or sharing the responsibility with someone else. Turning from record keeping missteps there to actual improper use of a trust account. And we've used these words kind of throughout the presentation today. So we're going to start with the first one, which is commingling. As we've talked about before, that occurs when you mix your, the funds belonging to you as the lawyer with the funds being held for the benefit of third parties or your clients. So when you mix those two, that's what we refer to as commingling. And that's covered by Rule 1.15 subsection A. And commingling can occur in a lot of ways. The most common way we see is when an earned fee is not removed promptly from the trust account. I have no idea why people would not remove earned fees from the trust account, because it's your money, you've earned it. You should remove it, but if it's not promptly removed, you're then mixing your money with the money held for clients or third parties, and that would be commingling. A second way commingling can occur is when a lawyer deposits personal funds in the trust account, and that can be just using the trust account as an operating account, as a personal account, doing it all in the trust account. And that, of course, is mixing funds. A third way commingling can occur is when a lawyer maintains a larger cushion of personal funds. Then, as we've talked about, you're permitted to have $200 as that cushion to cover incidental, maintenance fees, other bank fees in that regard, but only $200. So a way you could commingle is if you thought to yourself, oh, I want to be extra special safe and have $500 instead of $200 in case something unforeseen happens. And that would actually be commingling, because you're not permitted to have more than $200 of your own funds for that purpose. And another way that commingling can occur is when a client issues a single check for a cost advance, but also earned attorney's fees. So they just write one check that has both kinds of funds in them, and you deposit it in your trust account, but that would have been earned fees in addition to the advance for the cost, which the advance for the cost should have been in trust, but the earned fees should have gone to operating. Another example would be a flat fee agreement that does comply with Rule 1.5B, that means it can go into your operating account. But if you take that and deposit it to a trust account anyway, that would be commingling. And we're concerned about commingling mainly because it endangers the fiduciary status of the trust account and places any funds that are being held on behalf of someone else at risk, either from being like attached or garnished by a creditor, or simply by up to challenge. If someone wanted to challenge whether or not your trust account was truly a fiduciary account, and that would put all of your client funds in jeopardy. For example, the IRS has seized lawyer trust accounts, funds in a lawyer trust accounts to satisfy the lawyer's tax obligations when they have been able to determine that commingling was occurring, and therefore undermining the fiduciary nature of the trust account. So we don't want that to happen. We want all our client funds to be protected. And finally, are you subject to discipline for commingling? Yes, commingling has led to public discipline. A couple of examples are in Ray Kurzman and in Ray Saraway, where commingling occurred by keeping earned fees in the trust account for longer than 6 months, and also for commingling client and personal funds, and basically using the trust account as a personal account. So commingling is serious, it is important, and it most importantly can jeopardize all the client funds held in the trust account if it undermines the fiduciary nature of the account, and you can be disciplined for it. The next most common way to misuse a trust account is misappropriation. Misappropriation of client funds occurs when funds belonging to a client are not deposited in a trust account and are used for any purpose other than that specified by the client. Misappropriation can occur in a very obvious way, such as simply stealing the money from a client, taking the settlement funds and using them for themselves. But it can also happen when you take money and use it for something not particularly specified by the client. It is dishonest under Rule 8.4C and is a very serious violation. The Supreme Court, for example, has said that disbarment is the presumptive discipline for misappropriation unless there are substantial mitigating circumstances. And like I said, the most egregious form of misappropriation is just simply taking the funds and taking them, stealing them, not doing any work, paying your own bills. That's a very obvious example of misappropriation. And it is very serious discipline, and disbarment is the presumptive discipline for that. And to talk more about misappropriation, I think Susan's going to cover this topic.
I am. So I think that misappropriation is very clear to a lot of people. Of course, taking money, doing no work, and failing to make a refund, I'm going to start on the bottom, is essentially stealing the client's money. You might not have intended when you took the money not to do the work, but you don't do any work and you don't make a refund. The court has considered that misappropriation of the most serious kind that warrants disbarment absent mitigating circumstances. So that's clear misappropriation, something that we are seeing more of as people kind of abandoned work or struggled through the pandemic. And I hate that that's the case. I certainly don't anticipate that that's anybody on this call, but that's a serious case of misappropriation. What we're seeing more of, and I don't like to see as well, is that failing to deposit filing fees or cost advance into a trust account, keeping them in your business account, and then drawing down your business account to where you have spent those advance fees. Now, again, we like to think about, I think it's always helpful to think about, trust accounts are for other people's money. It's where you safekeep other people's money. Rule 1.15 is entitled safekeeping property. That is what it is for. when someone gives you money, a client gives you money or a third party to hold things in trust, they need to be in your trust account. If you do not put it in your trust account, it's a failure to safekeep. It's a Rule 1.15 violation, which the Supreme Court considers to be a serious violation of the ethics rules. If you then fail to safekeep it and then spend it, you have misappropriated other people's money, and that also is serious misconduct. I wrote an article in Bench and Bar, and for those of you who are not MSBA members, all of the articles that we publish can be found on our website that talks about the case of In re Quinn, where Mr. Quinn was suspended for 2 years for taking a bankruptcy advance filing fee, not filing the bankruptcy and not making a refund. And that's a $300 plus something like that amount of funds. He kept it for like 4 years. And spent it, not just kept it in his business account and didn't give it back, but spent it on other things. That's serious misconduct that the court decided didn't warrant disbarment, but warranted a 2-year suspension. We are seeing a lot of that. We have a lot of cases right now where people are just not putting advance expenses that they are receiving into their trust account, and then either dispersing those fees from the trust account or reimbursing themselves once they incur the expense at the time. And so that's the first item listed there. It will always be considered almost 2 violations: your failure to safekeep in the first instance because it wasn't where it was supposed to be, and then if you spend it, it's misappropriation. The second piece there is issuing checks from the trust account that exceed the balance. Maybe you're not keeping that client subsidiary ledger like you need to, or you haven't been reconciling like you need to, resulting in other client funds being compromised and used. So say you issued 2 checks to a client, they didn't tell you, you didn't realize you'd overpaid them. You're using other people's money to fund some client needs. That's often called negligent misappropriation because it results from your failure to keep accurate books and records. That is not as serious as misappropriation that results in disbarment or lengthy suspensions, but it almost always results in public discipline, which of course no one wants, arising from their trust account. And so that's why catching these things on a monthly basis is your absolute best defense. Going through, because you can negligently misappropriate clients' funds during the course of the month and actually not have any discipline come from it because you are engaging in the monthly reconciliation process that is meant to catch those errors. That's why the required books and record obligations exist, to on a monthly basis count those things that happen so you can correct it and make in a timely manner so that yes, you negligently misappropriated those client funds, but it all got taken care of at the end of the month when you reconciled the matter. Another thing that we see people do that I again hate to see is failing to transfer credit card or electronic payments that go into their business account, which is perfectly acceptable if you don't have that law play type where you can, kind of take the fees out of one place and deposit the money in one. Failing to immediately transfer those into your trust account and then inadvertently spending them. That's both a failure to safekeep and then misappropriation. So you want to, and the appendix talks about immediate. It says immediately transferring those credit card payments that you receive. So it's important that you understand there's a lot of services other than law play that people can use. It is well worth your money to use those compliant credit deceit types of services so that you don't end up forgetting advance payments in your business account and then inadvertently spending it. Again, misappropriation, this is the obvious one, paying non-client expenses out of a trust account. It is amazing how many times, and actually BLE has an obligation to report to us, people will pay their annual registration fee with their trust account check. They will pay CLE expenses, they will pay other expenses out of your trust account. That should never happen because that's not your money, because what's in there is someone else's money. That can happen by mistake if you're using the wrong check. But these are a lot of the ways that misappropriation looks to us, and it is always considered serious misconduct that will inevitably result in discipline. Just going to the next page, again, kind of what some of that looks like. Dispersing unearned client funds, paying yourself early is an obvious thing, or paying the client before funds have been cleared from the issuing bank, where you're misappropriating somebody else's money at the time. Again, there's the intentional way in which this can be done, and then there's the negligent way, because you're just not keeping track of what needs to be done. We have had a number of surprisingly instances where non-lawyer staff have misappropriated client funds. They have used money to the transfer to cover business expenses, thinking that they're going to be earned, or they know that it's going to come up. And the lawyer doesn't catch that because they're not watching what's being done, or they've authorized a non-lawyer person to write checks from the account, or not looking at their monthly bank statement, seeing that there are unauthorized transfers that are taking place that they had not addressed. Also, there's misappropriation to misappropriate law firm proceeds, sometimes dispersing to yourself or keeping for yourself, and failure to put in trust advance funds that are paid to the law firm. Usually that is not handled as, interestingly enough, the Supreme Court has kind of taken a different tack with respect to that misconduct, whereas, kind of stealing from your partners or others in your firm is less serious, results in less serious, but still serious discipline than, of course, misappropriation from client funds. We also see more than you would think in terms of, moving to the next slide, trust account scams. I remember when I first started as the director, in a short period of time, maybe 2-month period of time, I was on the advisory opinion line, and we had 4 lawyers who had fallen victim of trust account scams for significant sums. They look very similar to this, where someone engages you to do something that seems too good to be true. Sometimes it's a non-US client, sometimes they're getting more sophisticated. It can be domestic companies. It usually involves collection of some type of amount of money that is due to the supposed client. Sometimes you're asked to perform legal services, other times you're just asked to collect the debt and hold it to use your trust account. And you get things, you get the money, and then there are really a lot of requests to quickly disperse those funds before they've cleared the issuing bank. And we've seen variations on these scams where people will send emails, get emails that looks like it's from the bank, and will question a disbursement and want you to, provide information relating to the account. And then they will withdraw funds from that account. Like, what is the, additional information about the account password or electronic information relating to that. We have had lawyers who have been the subject, their trust accounts have been the subject of ransom, where someone gets a hold of their information or their bank accounts and tries to hold them hostage for that. So it is surprising. We've also seen where it'll look like somebody that you know is asking you to write a check or advance some funds, get gift cards, pay some expenses that seem not unusual, but they are also from a phishing email. And so it is surprising how many times this comes up and how many times and usually all through email. So having, kind of last October was Cybersecurity Month, having, talking to your staff about being vigilant about issues that happen, phishing scams and not falling prey to that. And then always taking care that you know who you're working with and not, and resisting the urge to disperse funds before you're absolutely confident that it has cleared the issuing bank. Particularly when there'll be places that will sometimes the banks will place holds on checks and then absolutely not dispersing those funds, because it's interesting that we continue to see trust account scams being successful with of course smart people on the other end of that phishing scam. But so don't let that be you. The last thing before we kind of take some questions here is that we have a lot of resources that are available to help you understand your trust account obligations and are happy to answer any questions that you have. On our website, we have an entire section about trust accounts. There's frequently asked questions. There's a brochure called Other People's Money that walks through a lot of this that you can share with your staff. Again, it shows examples of record keeping, what things should look like. There are ways in which you can use QuickBooks and Quicken handbooks for how you can use those software. Many people use Clio. All of that provides, and I think is well worth it to have electronic systems that are compliant, that assist you in this. Although we still see a lot of people kind of rocking it old school, sending us copies of old school check registers. Particularly for those who use their trust account periodically. But we do have resources on our website because we want you to get this right. We also sponsor an advisory opinion service where every day there's a senior lawyer in our office that's just available to answer your trust account questions. You can also call and talk to Krista, who's the attorney that supervises our trust account auditing program, overdraft and auditing program, or Annette, who is our forensic auditor, who both are happy to answer your questions, because again, we want you to get this right and we want you to understand. It can feel intimidating, but once you understand what it should look like on a monthly basis, things become much easier. And having some of those safeguards in place, just ensuring that those who are touching your trust account know what they're doing and that you're overseeing it. And if there's something out of whack, you stop everything once a month and make sure it's all good, are just really ways in which you are going to avoid having any issues relating to your trust account. And so we've been talking a lot for this hour and 25 minutes. So let's see if there are any questions that people might have before we do some closeout.
There is one question in the chat from earlier. It reads, when I opened my IOLTA in 2018, Wells Fargo told me it could not be tied to my ATM card. Have the rules changed on that?
No, it can't be. Oh, so in terms of why you could do an electronic deposit, that's a good point, because you can't have a withdrawal, but you should be able to have an ATM. You should be able to deposit electronically into your trust account. That should not be a problem. Maybe Wells Fargo does not allow that as a process, but you can't withdraw money and shouldn't be able to, but you should be able to electronically deposit funds. So
Yeah, they
that's
just clarified
interesting.
here, have not been able to make an ATM deposit into the IOLTA.
Right, and that might just be Wells Fargo specific, because there's not an ethics reason why you cannot do that. Any other questions?
Those are the only ones that I'm seeing right now.
All right, well, when we speak, we always want to make sure that people understand we get how stressful the practice of law is. And the last several years have been very trying for a lot of people. And we never want people to worry about their license or the fact that there might be issues in their practice, and worrying about that and avoid getting the help that you need, because the legal assistance programs in Minnesota, like Lawyers Concerned for Lawyers, do not report anything to us. They're confidential services. Another thing I also like to remind people, if as you've been listening to this and you realize you're doing a lot of things wrong, you have no duty to self-report. All you have to do is fix it. No duty to self-report. In Minnesota, you have an obligation, perhaps ethically, to report the misconduct of others that you know of if it meets a certain threshold under 8.3, but no duty to self-report. And always make sure to get assistance from services like Lawyers Concerned for Lawyers if you find yourself struggling, because we don't want to see that happen. And it is a large part of discipline. Can be traced back to people not addressing mental health or substance use issues that they have. And we do want you to get the care that you need. We are here to help you have an ethical practice. This is, again, you couldn't pay me to do this in private practice. I've been fortunate that I haven't had to do this. So I'm sorry that these are the requirements as it relates to handling other people's money, but these are important. It's actually among the most serious, because as Krista and Annette pointed out, you are holding this money in a fiduciary capacity, and we ask you to think of it in that manner and to understand your obligations. And if you don't, ask questions, because everybody is here to help you ensure that you are able to maintain the books and records that you're required to do without incident, so you can discharge that duty with confidence. So I thank you a lot for your time and attention today, and refer people that you know of if you found this helpful. We're so thankful to the Law Library for hosting this free CLE, because I believe it's really important that people have access to helpful, substantive information that allows them to maintain an ethical practice. So thank you to the Law Library. This will be on demand for the next 2 years. Refer it to others, because we would love to extend our reach and help as many people as we can meet their ethical obligations. So thanks so much. And with that, Sarah, thank you for hosting us.
Well, thank you very much for presenting. We will go ahead and close out now. As Susan mentioned, the recording of this will be available later, and we will be making this available on demand. So have a good afternoon,
As well as
everyone.
our materials, right?
Yes,
Excellent.
absolutely.